The current U.S. national debt stands at $34.8 trillion. For perspective, the U.S. population is currently around 333 million people, which translates to over $100,000 of national debt per person. However, the most crucial statistic is not the absolute value, but the trend, as my friend Richard from Bagel Bakery once remarked. One doesn't need to be an economist to recognize that this is an alarming chart. The most alarming aspect of this situation is that the U.S. government literally cannot repay the debt. The Congressional Budget Office has actually stated that in 10 years from now, the situation will be worse, not better. So where does this lead, and is there a clever workaround the U.S. might employ to address the debt issue? To delve into that, we must first grasp the fundamentals. The government is in debt to the tune of $34.8 trillion and is piling on more debt each year. But how does this mechanism actually function? Similar to individuals, a country goes into debt when it desires to purchase something it cannot afford. Just like us, a country has income and expenses, and if it wishes to spend more money than it earns annually, it can borrow to generate extra cash. This debt, akin to ours, necessitates repayment. If a country finds itself in a scenario where it cannot settle its debts, it defaults, just like a homeowner unable to meet their mortgage payments. How does this system operate in reality? When the government requires additional funds, it issues what is known as a government bond. Investors lend their money to the U.S. Treasury, which pledges to reimburse them along with interest at a future date. The interest rate one receives may vary depending on the duration of the bond or its maturity date. Currently, the U.S. 10-year Treasury yield stands at approximately 4.3%, representing an annual rate of return. It is also pertinent to note that it's not just you. For individuals, they can also purchase these government bonds. In the case of the United States, many businesses and foreign nations invest in these bonds. For instance, Japan, China, and the UK are significant holders of U.S. government bonds. If the U.S. were to default on these loans, it would have widespread repercussions across the globe. Another intriguing point to note is that the U.S. Federal Reserve, which serves as America's central bank, can also acquire Treasury bonds. This is how the U.S. engages in the process of printing money and infusing it into the economy. The Federal Reserve essentially generates money out of thin air and then acquires government bonds to inject this newly created money into the government's coffers. This is essentially how a country accumulates debt. Moving on to understanding the current situation in the United States, the primary reason a country goes into debt is due to spending more than it earns, commonly referred to as a deficit. The larger the annual deficit, the more money the government must raise through debt each year. For example, if the government spends $4 trillion but only generates $3 trillion, they would need to sell $1 trillion worth of bonds to cover the shortfall. Now let's consider the U.S. surplus or deficit over the years. In 2001, the U.S. actually had a surplus, meaning they earned more than they spent that year, with a surplus of $130 billion. However, since then, the trend has been declining. Even excluding the significant deficit years of 2020 and 2021, the gap between spending and income has continued to widen each year. This trend implies that to balance the budget annually, the government needs to raise increasingly more funds, meaning they have to sell more bonds and accumulate more debt. This pattern is evident in the data from 2001 onwards. The national debt stood at about $10 trillion, but as the deficit worsened over 23 years, the debt has surged to a staggering $34.8 trillion. This is a massive debt burden, and the issue lies in the fact that the U.S. cannot easily reduce it, and perhaps they may not even want to. Let's look at the breakdown of this year's budget. So far in this fiscal year, the U.S. has generated $3.29 trillion in income, but has spent $4.5 trillion. Since October 2023, they are approximately $1.2 trillion in the red. When delving deeper into how the government generated its revenue, 51.7% came from taxes, with 34.2% from individual income taxes, 9.4% from Social Security and Medicare taxes, and varying amounts from corporate tax, excise taxes, estate and gift taxes, and customs duties. Shifting to expenses, 21% has been allocated to Social Security, 14% to Medicare, 13% to interest payments on their debt, 13% on health, 13% on defense, 11% on income security, and so forth. It's evident that to rectify the deficit, the U.S. must either increase its revenue, reduce spending, or do both, options that are generally unpopular. Higher taxes, budget cuts to essential services like Social Security, education, healthcare, and defense are unwelcome prospects. Unchecked, this issue will only exacerbate. The Congressional Budget Office anticipates the deficit to swell from $2 trillion in 2024 to $2.8 trillion in 2034. This continuous deficit growth is projected to elevate the U.S. debt to GDP ratio from 99% this year to 122% in 2034, surpassing the previous high of 106% of GDP. America finds itself in a challenging position. Cutting back on certain areas or raising taxes are unpalatable choices. Adding to the complexity, the U.S. faces another hurdle after 2 decades: higher interest rates. The Federal Reserve, responsible for setting interest rates, has raised rates from 0 to roughly 5.5%. This matters because as government debts mature, the U.S. needs to repay bondholders. In a deficit scenario, when these debts mature, the U.S. doesn't have the funds to repay, so they roll over the debt, selling more bonds to settle old ones. However, in today's environment, this poses a problem. The older debt was sold at lower interest rates, while refinancing now requires higher rates. This situation, combined with the inflation of recent years, presents a complex economic challenge. As more debts roll over, the interest the U.S. must pay each year increases, raising their annual expenses and exacerbating the deficit. Interest has become the third largest expense category for the U.S., with $601 billion spent on interest payments since October 2023. The Congressional Budget Office's report indicates that interest costs are projected to rise significantly in the coming years. By 2025, interest costs are expected to exceed GDP levels more than at any point since at least 1940, reaching 4.1% of GDP by 2034, which would make up a significant portion of federal spending. With mandatory costs rising, discretionary spending will be significantly constrained, leading to tougher times, potentially higher taxes, or the need to take on more debt to cover increased interest payments. This situation is what is referred to as a debt spiral, where rising interest rates cause interest payments on government debt to increase, leading the government to borrow more, resulting in a larger debt burden with higher interest rates. To combat this, the primary option is to reduce the deficit and aim to return to a surplus in the long term. However, this seems challenging for the U.S. Some have wondered whether the U.S. might consider a different strategy, inflating away the debt. This approach involves leveraging inflation to decrease the real value of debt over time. To explain this concept, let's look back to 1970 when the median house price in the U.S. was around $24,000. The average annual salary was $7,711 for a full-time job, and a loaf of bread cost 24 cents. If you took out a mortgage back then for $24,000, looking at the same scenario today, the housing prices have risen significantly due to inflation. Wages, grocery costs, and housing prices have all increased. Today, that $24,000 loan would seem much easier to pay off due to the increased wages. This principle can be applied to the government's debt. When people discuss inflating away the debt, they mean that the government could accumulate significant debt and then allow inflation to erode the real value of that debt over time. By decreasing the value of their currency through inflation, the government effectively reduces the burden of paying back the debt in the future. Utilizing fixed-rate debt with depreciated currency is precisely the approach the U.S. adopted post-World War II. Inflation was employed to diminish the debt-to-GDP ratio. How might this strategy unfold today? It is closely linked to the Federal Reserve's practice of quantitative easing. Imagine this. The Federal Reserve generates a substantial amount of money to purchase government bonds, thereby increasing the circulating U.S. dollars. This infusion of fresh capital into government coffers can be directed towards initiatives like job creation, infrastructure development, or other programs aimed at enhancing national productivity. The ripple effects are positive. Heightened productivity leads to increased earnings for businesses and workers, resulting in higher incomes, augmented tax revenues, and decreased borrowing costs. This boost in investments causes asset values to surge, often accompanied by a rise in the inflation rate. Over time, as the U.S. economy surges ahead with a boosted GDP and sustained inflation, previous debts begin to appear relatively smaller. This phenomenon mirrors how the median house price and salary from 1970 seem petite compared to today's standards. While the concept of inflating away debt appears promising in theory, its implementation is intricate due to economic repercussions. One critical issue facing us today is the potential runaway inflation resulting from stimulative measures aimed at fostering inflation. Unchecked inflation, as history demonstrates, can swiftly spiral out of control, leading to economic instability, social unrest, or even currency collapse. Recent years have witnessed inflation rates in the US and other Western nations soaring beyond sustainable levels.